Welcome everybody to the next video, the official first video of chapter number 5, VAT return. In this video we're going to talk about VAT control account. You already know a control account is a total account of any particular account we're doing. For example, sales ledger control account, purchase ledger control account. This time it is a VAT control account. Well, all the debit and credits of the VAT, input and output VAT, you're going to put in this particular account. This is the account, T account. Yeah, debit side, credit side. Do remember, output VAT or income VAT, sales VAT, or reduction in expense, you can call it. Reduction in expense. All these are on the credit side, right? And input VAT, purchase, expenses, and reduction in income. All this transaction VAT should be on the debit side. This VAT we can reclaim. Excuse me, and this VAT, output VAT, income VAT, we are liable. We need to pay it to HMRC. Okay, just remember income, credit, expense, debit in terms of a VAT. It will help you to do rest of the question. Let's check out how to start from the credit side. Yeah, a VAT on sales from the sales daybook means credit sales. VAT on sales, it's an income, doesn't it? Or sales. Sales VAT, credit side. VAT on sales from the cash receipts means it's a cash sales. Oh, no problem. VAT we have gathered, collected from the customers, and we're liable to give it to the HMRC. That's on the credit side. They added up and written it here. Normally you don't do like this way in a T account, but this is just for your understanding purpose. VAT due on EU acquisition. Now there is a rule that if you buy anything from European acquisition, it should be treated once as input and once as output. That's why on the debit side it is an input. VAT liable on EU acquisition 211.78. Yeah, that's how we make it VAT neutral. You already know it, EU acquisition. Then net understatement. These are some adjustment. This is an adjustment. This is an adjustment. Even fuel scale charge is an adjustment. Yeah, these are all adjustment. Net understatement of output on previous return. Understatement means we showed less VAT on output from my last return. Now we are adding it with the output to make it higher. Next one is net overclaim of input VAT from previous return. We have claimed extra of input VAT, so we are writing on the output and making output higher because it is an overclaim of input. That's why we make it right from the previous return. Fuel scale charge is an output VAT, doesn't it? There is a figure would be given. It will be included, VAT included, and find it out. This is based on the CO2 emission, which you have learned in earlier chapters. The more CO2 you emit, the more it will be charged. It's a liability. And the last one is a purchase return. VAT on purchase return. Reduction in expense. Purchase return. So that is your VAT liability. Normally, you know, purchase return will be deducted from the purchases. Let me show you. They must have told you somewhere here. Yeah, we'll come back in this particular paragraph later on. So all the total tax payable is 6934.97. Let's check out how much VAT you can reclaim on the debit side. VAT on purchases. Purchase daybook means credit purchase. So we can reclaim that much of VAT. Purchases. Cash payments means cash purchase. We can reclaim that much of VAT. They added up together here. Normally we don't do in a T account. Just for your understanding purpose, we've done it. EU acquisition. Yes, we write on once in the debit, once in the credit. So it cancels each other out. Later in this chapter, we're going to check it out. There are 9 boxes to fill the VAT return account, and it goes in one of the 2 boxes. All the item goes into the different boxes up to box 1, 2, 3, 4, 5. All the VAT records. Then later on, sales and purchase. We'll talk about later videos even more detail. Bad debt relief, you have learned it last chapter. Bad debt relief, you can claim this from the HMRC based on your bad debt, and some criteria must be met. And VAT on sales return, your sales is going down, income is going down, sales return VAT, you can reclaim it. And total tax reclaim, or VAT reclaim 4480.81, which should be minus from the tax payable. How much is still payable? 2454.16. That much is still payable to the HMRC, and that much must be paid to the HMRC at the end of the quarter. Let's check out this particular paragraph. It says, in assessment, you will need to identify the impact that certain transactions have on VAT, specifically on the account. Remember, purchase invoice and purchase return affect input tax. Yeah, please do remember, purchase invoice and purchase return, these are related to input, doesn't it? Purchase invoice makes your input tax higher, purchase return makes your input tax lower. That's all you need to remember. And these are based on debit note, credit note received from the supplier. Whereas sales invoice and sales return, credit note issued to a customer, will affect output tax. Yeah, sales will increase the output tax, sales return will decrease the output tax. Keeping these in our head, let's do activity number 1. Credit note, impact on VAT. A credit note for taxable supplies is being processed. Credit note means sales return. Processed means we have issued a credit note. What will be the effect on the VAT? So it's the sales return, sales going to be affected. Purchase return, purchase going to be affected. So sales return deals with output VAT, sales deals with output VAT, and return makes it down. So decrease is the answer. These are not the answer. And that's all, people, from this first of facial video. Check out the next tiny small video for irrecoverable debt. Till then, goodbye.